An option trader that uses the short strangle strategy, they're looking to profit from minimal or no changes in the price of the underlying stock or whatever it is they're trading. And when you sell both a call and a put with different strike prices, you can maximize your chances of making a return even when there is very little movement in the price of the asset. So with this strategy, you have to understand that the upside in the trade is capped. On the other hand, the losses on these trades can be quite large, especially if you are lazy with your exit strategy. So the key to success with trading a short strangle is selecting the right strike price and having an understanding of how that stock price could move. So how do these work? A short strangle involves selling one call option with a higher strike price and one put option with a lower strike price. Now, both of these options, they have the same underlying asset, they have the same expiration date, but they differ in their strike prices. And when you put this trade on, it is established for a net credit. That means that the profits can be made if the price of the underlying stock remains in a narrow range between those break-even points. Now, the most that you can make on this trade is limited to the premiums that are received minus any commissions. But on the other hand, your potential losses are unlimited if that stock price increases, and they are substantial if it decreases. A stock can always go to zero, but the upside, we never know. So we're going to use an example of Foot Locker, which at the time of this video was trading at $35.38. So we're going to choose one strike out of the money for both the call and the put. And so for illustration purposes, we're just going to use the last transacted price. So we're going to sell one call at $37.50 for $1.15. We're going to sell one put at $32.50 for 65 cents. So because we are selling, we receive the premium, which is going to be $1.80 or $180 per contract. Now, as mentioned, your profit potential is limited to the total premiums that you received minus the commissions. The maximum profit that is earned if that short strangle is held to expiration. The stock price closes at or between the strike prices. Both options will probably expire worthless. Now, keep in mind that only around 7% of every option contract is ever exercised. Most traders are just going to close the position before the expiration. So using the Foot Locker again, the most we can make trading one contract would be the premium we received when we sold the call and the put for $180. And most traders of options will be happy to keep a percentage of that premium received, such as 60 to 80% of that. The maximum risk, the potential loss is unlimited to the upside because, again, that stock price can keep on going. On the downside, the losses could be substantial, but because that stock price can only go to zero, the downside is not going to be as drastic potentially as the upside. So having a strategy to exit your options trades are vital, especially if that trade is turned against you. So one approach for risk control to the downside is just close the trade when you lost a percentage of the premium that you received. So where do we find the break-even prices? It's pretty simple. It's the strike prices added to or subtracted from the net credit received. So in our example with Foot Locker, the upper and lower break-even points would be $39.30 to the upside and $30.70 to the downside. So using these points as your line in the sand is one way that you can manage your positions here. When would you use it? Well, when you use these, you are assuming that the price of something is not going to change a whole lot in the near future. So this way, if the price stays between those two strike prices, you're going to make some money. But just remember that the prices of calls and puts, they all depend on what other traders think are going to happen. So for a strangle to work, other market participants must feel that the current value of the underlying stock or whatever it is acceptable. But what we do not want to happen is for there to be a change in the bias, and that could send the stock drastically in either direction. Is a short strangle good to use? Good and best, they're all subjective, but there's pros and cons. Well, unlike a straddle, the short strangle, the break-even prices are further away from the underlying price when you set the trade up. So this means that a strangle can absorb more price movement in the underlying than the short straddle can. And because the prices are further away and the underlying must make a large move for the possibility of the options being exercised, a trader has the potential to keep the majority of the credit received. Also, using out-of-the-money strike prices, they're cheaper for the buyer, so the premium that you receive and your maximum profit are less than they could be if you're using another strategy. Just simply compare those last prices at the strikes that we use to the last prices at the $35 strike. Here's some quick hits. What is a short strangle? It's a strategy that involves selling both calls and puts at different strike prices with the same expiration date. You can make money if the underlying stock stays within a certain range. How much can you make? The maximum profit earned is only if you hold with expiration, and that will be the premium that you receive. With break-even points, they are simply the strike prices added to or subtracted from the net credit received. When do you want to use it? Best used when you think that stock price is not going to move a whole lot in the near future. Now, no matter what strategy that you're going to use when you trade options, it's really important that you have a risk management strategy and you have techniques in place to get out your trades. So using a short strangle, it's going to allow you to use the upper and lower break-even points as your line in the sand. That way, price of the underlying moves too far in either direction, close out the trade and potentially still have a profit. Now, with proper risk management, trading options can be a great way to make money in any market climate. And you can actually profit from up and down markets. And this guide here is 100% free. It's called a Volatile Market Secrets. That's our PDF. You can download it, link above, link below. Thanks for watching.